Thank you. Mark Mahaney, I'll go to you on that. Perhaps Wall Street knew that the comps were going to be tough from the COVID environment. What might be surprising is that they expect year-over-year, two-year revenue growth. So in other words, comparing it to 2019 to decelerate modestly in the second half of 2021. Is this a disappointment to you?
No, I think they had said they'd use that, if you want to do Fed speak on this company, they'd use the language of significant deceleration last quarter. The issue here is you got an expectations correction. Look, you had Google last night that put up 10% upside. This company put up upside to the street, but not that high. I think there were expectations, including ours, that they could print as much as 30 billion. So everybody was looking for upside. They didn't get quite as much upside. There's nothing that's changed for the fundamental long-term investor, but the near-term expectation was a little bit, came in a little light versus that. And now you are looking into tough comps in the back half of the year. So I don't know if the deceleration is going to be significant or not. My guess is that they overstate that, but there will be deceleration. It's going to be a little harder for any stock to re-rate when you go through a period of deceleration. We could well see just a consolidation of year-to-date gains through the back half of the year.
But if growth is slowing in any way, shape, or form, Mark, it doesn't cause you to rethink your rating on the stock? I mean, it has to happen at some point if their growth rate is going to slow, doesn't it?
Oh, yes, it does. It depends on whether they'll maintain premium growth rate. I'm pretty certain that you're going to get premium growth rate out of Facebook for the next 3 to 5 years. And I mean like 20% plus top line and bottom line growth, and probably be better than that on the bottom line. Also, step back. What's the valuation like on Facebook today? It presents as trading at something like 26 times GAAP earnings. But if you take out that cash, and what I really want to know is, and investors should want to know, is how much are you really investing in Oculus and virtual reality? I think they're investing more than people realize, i.e. this company is under earning. The earnings power is actually stronger. So I think this thing still trades at like 22, 23 times earnings. And I think that's fundamentally attractive for an asset that can do at least the next 2 or 3 years is somewhere between 20 and 30% earnings growth. At that scale, that's rare bird. We still like the stock, but near term, wouldn't be at all surprised to see consolidation.
Mike, they also say they expect ad targeting headwinds from regulatory and platform changes and the iOS updates, which is something that has been, investors have been watching pretty carefully. Hasn't affected these companies yet.
No, and I do think you could probably say there's a note of caution or maybe excess caution in how they describe these things. They want to be out there saying that they're attentive to them. I don't think, I mean, the consensus was basically irrelevant on this. I mean, it barely went up since the end of April in terms of the quarter's EPS, and the stock was up 22% or something. So that kind of shows you the mismatch Mark's talking about, the expectations getting ahead of themselves. But I do think you have to be on alert for that. It's been the case for a very long time that it has not been in the management of Facebook's interest to bring a lot of attention on how profoundly profitable and great this business is. It just doesn't make sense to say we can't help but make all this money. So I do think you can kind of maybe kind of use that as a filter for how you interpret their cautious statements about ad targeting down the road.
It's astounding when you make $29 billion in a single quarter in terms of sales.
Shepard Smith here. Thanks for watching CNBC on YouTube.